All right, guys, here we go, going out live on Facebook. And we're here with Erica, of course, from Waypoint Noven, Director of Operations. I'm Will Lambert, and with Bryce Olsen. This this guy here is something special. I met him in San Diego, and I mean special, like, pretty dang special. And we met at a conference in San Diego. We hit it off immediately, and we've been connecting ever since. One thing that I always judge trainings or classes or anything like that, especially at conferences, is did I walk out? Most of the time, I walk out of a lot of stuff. I actually made it through Bryce's conference, which is just amazing. And
For two
so
hours. 2 hours.
it was a 2 hour one. It was beautiful. I learned about the colors, red, blue, green, brown, all that stuff. That's a whole another time frame for us, and we'll get that, of course, out here, I'm sure. But I'm gonna let Bryce take it away. He's gonna give us some insight into 2026, 2025, what we saw. And yeah, let's let him take it away.
Thank you, Will. Yeah, that was a fun class. I was glad that I convinced you to stay for the 2 hours. Um, Fortunately, it wasn't a super tough act to follow. Like that can always change things. But yeah, I appreciate the kind words and thank you for putting this together. I'm super excited to teach and present. That's something that I'm very passionate about and I love to do. So as we go through this, if you guys have questions that come up, please put them in the chat. And if there are questions, we'll address those at the end. So we do have a lot to cover. I'll try not to get too quick with some of the content, but the purpose of this is to really figure out how we can overcome the objections that we get all the time. And in my opinion, the top objections we got in 2025, at least the ones that I got, and you guys feel free to tell me if you get something different in the chat. I'm going to start sharing my screen now, so you should see that. But the top objections that I got most often was house prices are too high, interest rates are too high, I'm stuck in my 3% loan, or my favorite is I'm waiting for the market to crash. That's my favorite conversation. Um, so this topic and this presentation is meant to combat those objections. And in order for us to do that, I think the key for us to being able to overcome those is knowledge and education. If we can educate the clients on why things are where they are or where things are going, that makes the conversation a lot easier. And now we're not selling, we're just having a conversation. So again, put any questions you have in the chat. And before I get into 2026, I just want to kind of recap 2025. And the reason I want to do this is to give you a little bit more confidence in the data and the information that we're sharing. So I've got to give a huge shout out to Barry Habib and Dan Habib at MBS Highway. I've followed Barry probably, I don't know, last 18 years of my career or so. So he's the interest rate advice that I trust the most. And his son Dan as well. We're in the same coaching group. So I just wanted to give some context there. Barry won his fourth Crystal Ball Award last year. My guess is when that's announced, I think it's in March, he's probably going to win his fifth. And that's based on who most accurately judged the market throughout a year. So it's a pretty prestigious award to win if that's the field that you're in. So this was Barry's 2025 forecast. So I just kind of want to run through this to give some context. So he expected the 10-year treasury to hit a low of 3.8. We actually hit a low of 3.89. Very, very close. He expected the 30-year fixed rate low target to get to 5.75 to 6. Actual is 6.1. Keep in mind that's a national average. Like I closed several loans in 2025 that were under that 6.1%. So that's an average for the nation. It's not across the board for everybody. So again, though, he was still pretty close on the estimate. Mortgage spread I've highlighted because this one is really, really important. He forecasted a spread of 2.25%, started the year at 2.8%. The actual was 2.2, so really close. So what am I referring to when I say the mortgage spread? There's a big misunderstanding that the Fed funds rate is what determines interest rates. And it does have an impact, but it's not a direct tie as far as impact. Is what the direct tie is is with the 10-year treasury and mortgage rates. So a normal spread, which I'll get to at a later slide, is between 1.5% to 2%. And we're gradually making up ground on the spread from mortgage rates to the 10-year treasury. So that's what he was forecasting, is how much was that spread going to be between 30-year fixed rates and the 10-year treasury. So he was really, really close on that. We're going to go into more depth on this later, so don't worry about that. Home price appreciation, forecast 3.5. Redfin had it at 2.6. So a little bit short on appreciation. Unemployment rate 4.5, and it's currently at 4.6. So really, really close on that as well. So he was really close on 2025, which is why I think he's probably going to win that award again come 2026. So going into 2026, what are the things that are going to impact interest rates the most? Is what the Fed is looking for. And this is where you can have conversations with your client and help interpret the information and the data that's out there. Is number one is inflation. Fed's looking at inflation as a key component, employment and unemployment. So let's talk inflation. Don't get too worried about the percentages here, but the Fed's target for inflation is 2%. That's where they would like to see inflation go. And their favorite measure of inflation is the PCE report. So that's the one that they watch. As you can see, it is trending lower. So we're moving in the right direction when it comes to inflation, which is great for interest rates. Is why this is important to have a conversation around inflation, is because there's a big component to it that it's really just kind of a shot in the dark, and it's a guess, and that's the shelter number. So shelter consists of rent, which is a real number. Also Airbnb, short-term rentals, so vacation rentals are factored into that. And lastly, there's something that's called owner's equivalent of rent, which is a complete guess on how we come up with this, but essentially it's a household survey. The Bureau of Labor Statistics makes phone calls to a bunch of households and says, hey, Will, if you were to rent your house today, like, what would you rent your house out for? That's a terrible question to ask a homeowner that's not in real estate, because they have no idea. So they're completely taking a guess at what they could rent their home for. And I'm sure, just like sellers, everybody thinks that they can rent their house for more than what it would actually rent for. So if that number is grossly too high, that keeps inflation too high. So there's a big lag in this number because it's a year old. So is why that's important, is to look at the overall trend, that it is going in the right direction. And that's what we want to be focused on, is inflation going in the right direction or the wrong direction? And right now we are going in the right direction. So let's look at the current PCE number at 2.8. If we have overestimates of tariffs of 0.3%, which the Fed thinks are a temporary hit to inflation, which is great, so not long term, there's that shelter lag of 0.3%. Portfolio management of 0.3% is what that means, is what do, like, a financial advisor, what are they charging the clients to manage the funds under management? So if we were to back those things out that we really don't have any way to gauge what the impact is, actual inflation's at 1.9. So we're definitely in a really good spot. And the forecast for 2026 is to see that PCE number come down to 2.5. So continuing to make progress towards the Fed's target of 2%, which is a made-up number as well, by the way. Alan Greenspan just threw that number out at one point in the early 2000s, and somehow it stuck. And that's what the Fed goes off of going forward, which is kind of interesting. So let's move on to labor. Is what's important with labor is think of this from a job creation standpoint. If job creation is really high and unemployment is really low, that's inflationary, meaning more people have jobs, more people have money to spend, and so they're out there spending it, which causes inflation to go up. If job creation is low and unemployment is high, that is actually deflationary, meaning that inflation is going to come down because there's less people out there spending money, which it sounds kind of bad, which I'll get to it in a second. But let's look at job openings going back. This goes back to spring 2022. So job openings are clearly on the way down. So there's not a lot of job openings happening. So that's good for interest rates, not good for people looking for a job. But it is good for inflation and interest rates. Once someone loses their job, this is called an initial claim. So if I were to lose my job, I go file for unemployment. That's an initial claim that shows up in the jobless claims numbers. The Fed's confused as to why initial claims aren't reflecting unemployment. And the reason that claims are not reflecting unemployment is because people just can't live off of unemployment. So when they lose their job, they could go file for unemployment, but they're not able to support their bills, the cost to live. So most people are turning to other jobs like Uber, DoorDash, things like that to supplement their income. I actually have a client right now that wants to refinance. He just went through a divorce, really wants to get his payment down, and he's driving Uber to supplement his income, and he's an attorney. So he didn't lose his job, but he's got some additional bills now with the divorce, so he's trying to supplement his income. So those people aren't running to the unemployment line. They're going to find whatever jobs they can to live because unemployment doesn't support it. So Dan and Barry's perspective is that the reason that those aren't lining up is because those folks are going and getting other jobs, not actually filing for unemployment, which is why it's not going into the claims number. Now let's talk job creation. The ADP job reports, which ADP is the largest payroll company in the country, over the last 4 months, they've showed a net 17,000 loss in jobs. So you can see below the red line, we've actually lost more jobs than we've gained. So that's not great for employment. And let's look at the Bureau of Labor Statistics report, which is what the Fed looks at. So that Bureau of Labor Statistics jobs report is still really weak, but it's very, very much overstated. Our Fed chair, Jerome Powell, actually gave in his last press conference in November, admitted to the fact that these reports are probably overstated by about 60,000 jobs every single month. And there's a report that kind of finalizes how well did the BLS do in their numbers from October of 2024 to October of 2025. That report indicated that they had overstated jobs by about 1 million jobs. So well over the 60,000 per month. But the Fed is factoring in that more than likely that jobs report is not accurate. But this does show that it's still overall in a negative trending pattern, which is good for interest rates. And last, unemployment. Unemployment has clearly risen over the last several years, and the forecast is for it to continue to rise up to 4.8. So as I said, for interest rates to be impacted in a positive manner, we're looking for weak job growth, we're looking for the unemployment rate to go up, and we're looking for inflation to go down. Now, it's not hard to draw the line that probably leads to something like a recession. So most people get really, really concerned about housing when it comes to a recession. So let's talk about how that's impacted. Mortgage rates during a recession, if we go back to the last 6 recessions, including 2008, overall interest rates did go down during a recession. So the reason being is the Fed needs to come up with ways to spur the economy forward, get people spending money, get things going forward so they drop interest rates, which then leads to mortgage rates to come down as well. So is why this is important is with a 1% drop in interest rates, if we just look at the most recent, which is that 2020 period of time right here, a 1% drop in interest rates, that's approximately 5 million home buyers come back in the market that are now able to purchase a home, can get pre-approved for a home. So there's a lot more competition that's going to come into the fold with rates coming down. Now let's go to the market crashing situation because that's always a fun one to address. What happens to housing demand when we're in a recession? Outside of 2008, you can look at every single recession in the past, except for maybe the Great Depression. Real estate's improved. So if we look at this dip in housing demand, well, that was due to the amount of foreclosures we had in 2008. That was caused by real estate, not realtors. It was caused by really, really loose lending guidelines, really risky loans that were being done. I was doing loans during that period of time. Will and I have talked about this. It was a very crazy period of time. And if you want some context for that, just watch the movie The Big Short, and it's really going to give you a lot of insight as to what was happening during that period of time. And it's pretty accurate and pretty spot on. Like I lived through it. So housing stays strong through recessions, and so does interest rates. And something to consider here is it doesn't necessarily impact the buyer pool that's looking to purchase a home. A lot of times, the people that are impacted the most with low job growth, unemployment, and things of that nature aren't necessarily folks that have purchasing a home on their mind. So it doesn't really impact our buyer pool all that much, but it does impact the mindset of the buyers that are in that pool, which is why we need to be able to have these conversations with them to help ease the fear and help them realize that it's not actually as scary and not as bad as they think it might be. So this is all information to help you have the conversations, and to have the conversation with the data. Now it's education. I'm not selling you, I'm educating you, and then you get to make up your own decision. So let's move into the Fed, because there's a lot of changes coming for the Fed in 2026, which is going to also be helpful for interest rates. So we have new Fed members, and looking at the list is what a dove means. Is a dove means they're in favor of lower interest rates. A centrist means they can go either direction, so they can be swayed one way or the other. And a hawk means they want interest rates to stay higher. So looking at this, we have more people that are in favor of lower interest rates than we do that are in favor of higher interest rates. And the new Fed chair is going to be selected. That's going to be announced here sometime in the next probably couple weeks or so. The guess is it's already been pretty much a foregone conclusion that that next Fed chair is going to be in favor of lower rates as well. So overall, that's going to help us in 2026 when we have more Fed members that are in favor of lower rates than higher rates, which that hasn't been the case in the past couple of years or so. Currently, the Fed funds rate sits about 3.7%, 3.75. We're expecting to see that come down to about 2.875, so about a 1% drop. So they're forecasting about 1% lower Fed rate by the end of next year. And some additional things that can impact interest rates that are outside of inflation and employment. Some things that can impact that are additional debt. So President Trump announced today that he wants to basically double the military budget in 2027. So the interest rate market didn't like that, because in order to do that, we're going to have to take on more debt, as if we don't already have enough. So the market doesn't like that, because we just faced in 2025 an issue with the debt ceiling, which is why the government shut down. So that's not something that's good for interest rates. These other four items should be more in favor of lower interest rates. Terming debt shorter. I'm not going to get into a ton of detail to that, but it has to do with what does the Fed Treasury do when it comes to treasuries coming off of their books. The Genius Act has to do with Bitcoin and digital currency. Fed QE, which is the Fed easing their stance, and then bank deregulation. So if there's less regulation on banks, it's less expensive for them to originate loans, which then the cost per closed loan can go down, which means interest rates can get better. So they're looking for some deregulation when it comes to banking as well. So now we're going to look at this really wacky chart. Don't get too consumed with the Christmas tree. But the purpose of this is just to kind of talk through like how volatile interest rates can be, and also show the periods where interest rates hit their lowest. Because I love that conversation with the client that says, well, I'm just going to wait for interest rates to come down. Okay, well, let's see how likely that is to work in your favor. So in 2024, the 10-year Treasury got down to 3.7% and 3.6%. So that was the lowest period of interest rates we had during that time period, which I remember locking. I closed several VA loans at 5.75, and I believe I closed some conventional loans right around 6%, maybe 6.1. So someone that comes in and says, hey, well, I'm going to wait for interest rates to come down, you can see on here, like especially this one right here in 2025, like rates were that low for a day. So, and in most cases, these are short windows of opportunity. So if a client thinks that they're going to time the market, get into purchasing a home, get that interest rate locked when interest rates are at their lowest, like they're going to have to be very, very lucky to do that. The people that end up getting the best interest rates are the ones that are already in the market, ready to go. And if for some reason, they bought when rates were higher up here, well, as rates come down, there's an opportunity to refinance. So we're going to cover the cost of waiting in more detail later in this presentation, but the purpose of this is to show the market is so volatile that if someone thinks that they can time this perfectly to get pre-approved, get out shopping for a house, find that house, get under contract, then get us the contract so that we can lock it for you, all in that window that rates are at their very best. I mean, if I could time that perfectly for every single one of my clients, I wouldn't be doing this presentation right now. I'd be living on an island somewhere and just enjoying life. So the odds of that are very, very low that someone's going to be able to do that. That's the purpose of this slide, is just to show, like, that's an unrealistic expectation if our clients think that we can do that on their behalf. So let's go back to what I covered on that one of those first couple slides, which is the spread. So here's what the spread means in more detail. Typically, it's between 1.5% to 2% that the 30-year fixed mortgage rate in comparison to the 10-year treasury. So from 2015 to 2019, interest rates were somewhere between, I have it right here, somewhere between 3.8 to 4.7, and the 10-year treasury was between 1.8 and 3.25. So it stayed, as you can see, in 2015 right here through 2019. We were well within that spread throughout that period of time, and rates didn't move a whole lot. I mean, we stayed within a just over a 1% spread between interest rates. So it was a pretty calm market. Things just went a little bit crazy once COVID happened. And that kind of threw a wrench in a lot of things for us, unfortunately. Um, but that's what we're recovering from right now, is all of this chaos in the spread is now finally starting to work its way down. As you can see, we started January 25 at a 2.6 spread, currently at 2.12. The worst it got was back in October of 2023. The 10-year treasury hit 5% and interest rates hit high sevens. That's when we were 7.75, 8% on some rates. But you can see that only lasted for a month. So it was a very, very short period of time. But this is to give confidence to the consumers that the market is returning to a more normal level that we saw for 8 or 9 years, once all of the mess from COVID is being kind of worked out of the system. So how do we get to, say, 5.7, which was Barry's forecast for the low? If the 10-year treasury were to come down to 3.8, it's currently trading today at 4.16, I believe is what it was the last I looked at. So not a huge decline to get to 3.8. That spread continues to narrow to, say, 1.9. Now you've got a 30-year fixed rate at 5.7. And on top of that, if the spread were to narrow even more to, say, 1.7, now you're looking at a rate that's 5.5. Or even 1.8, now we're 5.6. So the 10-year treasury doesn't have to move down as much if the spread continues to narrow between 10-year treasury to 30-year fixed rates. So that's why we've seen interest rates continue to improve, even though we haven't seen as much of a drop in the 10-year treasury. So over this year, the 10-year treasuries come down about 0.4%, but we've seen interest rates come down about 0.9%, and that's because that spread's been narrowing. So that's better for interest rates. The forecast from some other folks, Fannie Mae has it at 5.9. MBA, which is the Mortgage Bankers Association, has it at 6.4. So kind of a spread between their average of 6.17, but MBS Highway has it at 5.7. And based on how I showed the 2025 data, how accurate they were, I'm going to follow Barry on this one. I'm going to trust what he has to say. And just to kind of recap the rest of the numbers, because this is important when it comes to interest rates. Unemployment to be at 4.8, inflation to be at 2.5, the Fed funds rate to come down to 2.87, mortgage rate low to hit 5.7, appreciation to be 3.5. Like my county, Weber County, I think it was projected at 4.5, historical 4%, which we're going to get into some of that stuff too. And this is important when it comes to the folks that we think are stuck in their interest rate and they're not willing to move. The percentage of people that had a rate between 3% and 4% is down 9% than from where it was. And people that had a rate below 3% is down 4.5%. So people are giving up their low interest rate loans to get into another house. But the ones that are doing that are the ones that we can have the right conversation with to see that it's not as far out of reach as they think that it is, which is what we're going to cover when we get into some solutions. So, what is the solution? My personal opinion with that is it's education. If we're not able to educate the clients correctly, then we're not going to be able to get them to make a decision one way or the other. So let's go back to those most common conversations that we've had. Number one being the client who's kind of not sure, not ready. That client falls into the category of rates are too high, home prices are too high, the market's going to crash because they don't have the information they need to make a decision. So that's why they're kind of not sure, not ready, because they don't know whether or not it's the right decision to make. The other ones are the ones that are trapped in their home. And last but not least, are you ready and pre-approved? That's the client we all wish we could have all of the time, but the reality is not very many of them fit that bill. Like I do get some of those clients periodically, and it honestly it throws me off when I get that client that's like, nope, the market is what it is. I'm just ready to go and I'll refinance later. I'm like, so wait, I don't need to like talk to you and educate you at all. Like I had a conversation with that client Monday, and I was like, wow, okay. So then we just got to talk strategy on how we were going to structure that loan, what we were going to do with this funds. So it was still a really fun conversation, but he had just made the decision that he knew he was going to buy another house. He wasn't going to rent. It's not what he wants to do. So what are we up against when it comes to this? Because we have a pretty big hill to climb when it comes to these conversations, especially when our clients are seeing headlines like this. So we're selling products that people don't want. This article was done in October of 2025 with Forbes that nearly 70% of Americans think the economy is on the wrong track and even more think it's a bad time to buy a home. 73% in the same article said it's not a good time to buy a home. That was the percentage for I don't want to buy a house. I think it's a bad time. That's a big number. It is down from 86%, which this other article is a Housing Wire article that was put out in June of 24, and it was 86% at that point in time. So we have way more people that feel like it's not a good time to buy a home than we do that feel like it's a great time to buy a home. So it's a challenging situation for us to be in to help them view things through a different lens. Again, we're not trying to convince somebody to do something that isn't in their best interest. We just need to give them the education to then decide whether or not it is something that they should do and whether or not it is in their best interest. This is one of my favorite charts that I've seen. This goes back to 1942, and it shows the average interest rate and home values all the way back to 1942. In that period of time, we've had 76 years where the market has appreciated, 7 that it hasn't appreciated, and 1 that it was a tie, meaning it was 0. So I did add in here 2023, we saw average interest rate 6.8, 24, 6.9, 25, 6.7. That's the average. So factoring in the highs and the lows. Values, we still remained positive at 5.5, 3.9, and 2.6, which was that Redfin number. Again, these are national averages, but 26, we're expecting the forecast. I know for my county, like I said, it was 4.5, and Santa Fe County, I believe, was even higher than that. Will, I want to say it was closer to 5. On that, the next comparison, I did use the historical, which I always take whichever's lower when I do these comparisons, which I'm going to get to. So people that are thinking that the market's going to crash, that high percentage that it's not a good time to buy a home, we really need to ask questions as to why do they think it's not a great time to buy a home. And they're probably going to fall into one of those categories that we already discussed. But the people that think that the market's going to crash or they're going to buy a home and they're going to be upside down in it, my favorite question to ask is, well, when do you plan to sell this home that you buy? If they're not planning to sell it within the next 2 years, they're probably fine to go ahead and purchase a home. But if they are looking to sell it in a year or two, yeah, it probably doesn't make sense to buy a house more often than not. But I like to ask people the question of, okay, so for homes to be more affordable, what do you think needs to happen? Like, what do you think needs to to happen for a home to be more affordable? And more often than not, that people go to the sales price. Well, sales prices are just too high. Okay. So in order for a home to be more affordable, we need home prices to plummet, is what you're saying. So, which the odds of that happening are very, very low. The average consumer today in America has more than 50% equity in their home. So if home prices were to plummet 20 or 30%, that person that has 50% equity probably just isn't going to sell their house right now. They're just going to sit tight. No point in selling it if I don't have to. The only way that we get to a huge reduction in sales prices is if we have a huge amount of inventory come onto the market, which is why in 2008, so many, the home prices have went down so much is because there was so many foreclosures that sellers were begging buyers to purchase their home. Like buyers had their pick of however many houses they wanted to. So the only advantage a seller has was I just have to be cheaper than my neighbor. If I'm cheaper than my neighbor, maybe I can sell it. That's really not the case today because people aren't in a situation where they're facing foreclosure. Foreclosure rates are very, very low. It's in the 3%, low 3%. So with foreclosures being very low, defaults being very low, if home prices were to plummet, it would need to come from that scenario. And I just don't see a path to that. And I don't see a path for home builders to flood the market with inventory again, because that's also what helped lead to 2008, not blaming the builders, but there was a huge influx of new construction. So I just don't see a path for home prices to plummet to the point where now everything is affordable. So we can kind of take that one off the list. The next one is for, if Erica wanted to purchase a home today and she's like, I just need to make more money. Like it's just not affordable unless I could go get a better paying job. I showed you the employment outlook. It doesn't look great. So the other option is I need to give Erica a raise. If I'm her boss, she works for my company, I've got to give her a pay raise. Well, I run my own business. I'm sure a lot of you guys run your own business. If let's say your transaction coordinator was like, hey, I really want to buy a house, but you need to give me a $20,000 pay raise a year so that I can afford it. What's that going to do to your P&L? Probably not put you in a good situation. So again, I don't see a pathway for employers to give these massive pay raises in order for people to afford homes. So the most likely path for me is lower rates, which we've showed the 10-year treasury doesn't have to do a whole lot as far as coming down to a reasonable range before interest rates are dramatically lower. In 2020 and 2021, it was 0.5%, which is why interest rates were 2.5. It was crazy low. So even if the 10-year treasury could get to a normal range like we saw in 2015 through 2019, we're talking about interest rates in the 4%. When that happens, I don't know, but that seems to be a more likely outcome than home prices dropping 30% and everybody in the country getting a pay raise to offset the affordability. So moving on, that's enough of a soapbox on that topic. But as you can see, that is my favorite conversation to have, because once you have that conversation, people are like, all right, yeah, I get it. It's probably not going to crash again. So then it comes up to those people that are like, I'm just going to wait. I'm going to wait 6 months. I'm going to wait a year. That's great. But they need to understand what is the downside if you wait for that period of time. So this is for Weber County. This is the county that I'm in. If you're not from Utah, you might think it's Weber, but it's Weber. So let's look at this. So I did the lower of the two, which forecasted was 4.5. I did historical, which was 4.03, and the median sales price in Weber County is 450. So if someone was to wait 6 months with a 2% appreciation rate over that 6 months, that home price goes from 450 to 458,989. So an $8,989 increase. If they wait a year and we hit that full 4%, that home now came up to 468,157. So we see the appreciation gain that they're going to have to pay. We do need to factor in the benefits that they would get if they waited, right? So if they wait, and this is factoring if interest rates after a year went from 6.125, which is what I have in here as a comparison, 6.125 to 5.5. So this is a 5/8% decline in interest rate. That's going to save them on their monthly payment $56 a month. It's only $56 a month because this home price went up almost $20,000, which means their loan amount went up almost $20,000. So over that course of the year, they'd save $672 in payments, which that goes in right here. We also need to factor in the cost of a refinance. So if Erica decided that she was going to buy a house today and she's like, look, all right, I'm just going to move forward. I'm going to buy a house today and I'll refinance when interest rates come down. Well, we want to factor in that cost of the refi. We don't want to just be blind to the fact that there is costs for that. So we're going to factor in $4,000 to cover lender fees, title fees, the taxes and insurance somewhat wash because they're going to get their escrow account back when we set up a new one. So we're not factoring that in. But between those two, the benefit of buying now is going to save her $13,485 if she buys now versus waiting a year, even with a lower interest rate. Waiting 6 months, we can still take this $8,989, factor in half the savings, which it's not even half the savings because the 6 month comparison I have interest rates at 5.75, not 5.5, plus the cost of the refi, she's still ahead. Even if she waited 6 months, she's still going to come out ahead. So is what I like to point out on this, which I'm going to go into the Santa Fe one first, and then we'll cover that. So this is comparing Santa Fe. I did use the lower of the two, which was 4.25. I think the forecasted was closer to 5. So same scenario, median sales price there was just over 585. So I put 585 in, a $20,000 difference buying now versus waiting a year. The only scenario that mathematically makes sense to wait is someone that's going to downsize, which that's my parents. My parents are in that situation and he's chomping at the bit to sell his house and buy another house. And I'm like, you're actually better off if you don't, because he's going to be going drastically down in a sales price, what his home is worth versus the house he wants to buy. I can run 50 of these scenarios for every homeowner that wants to sell their current home and move up into a bigger home or a better home that's better suited for their family. Every single scenario, the consumer is better if they buy now versus waiting. Every single one. I've never ran one that mathematically that number's red for a move-up buyer. But is why this is so powerful is it's one thing for me to tell Erica, hey, like you're going to cost yourself a lot of money if you go ahead and you wait a year. Like if you don't move forward now, you're going to cost yourself a lot of money. If I just tell her that, immediately that feels as though I'm trying to sell her or convince her to do something different. But if I can say, hey, let me like help you see the math. This is what I love about math. It doesn't lie. If I show you the math where this doesn't make sense, now they're like, okay, so you're not just trying to convince me to do something that you want to do, that you want me to do. It's actually in my best interest if I do move forward. That's the purpose of these. And again, this is a worst case scenario. Or actually, sorry, this is a best case scenario. Like best case, if you wait a year, this is what it's going to cost you. The conversation that we don't have is, sure, if this house goes up 4.25% and now it's 609, if interest rates are 5.5, as I showed on some previous slides, how many more consumers are now in the market that are ready to buy? Are you going to get that house for 609? Or now are we in multiple offer situations? Are you going to be able to get concessions to help cover closing costs? Are you going to have to go over asking and possibly pay an appraisal gap to get that house? That's where I say this is like a best case scenario that it costs you. If you now have to pay 5,000 over asking or 10,000 over asking to get that house, this 20,000 number just became 25 or $30,000 instead of 20. So this is a very, very, very powerful tool to show clients because they get to see what they're asking for. And I tell all of my clients, look, if you still choose to wait, that's fine. I I don't care if you choose to wait. I just want you to know what you're getting with the decision that you make. And if you're good with that decision and you're good with the results, I'm good with the results. But the last thing that I want to have someone say is, I don't have this conversation with them. And then 6 months down the road or 12 months down the road, this is the situation that we're in. And then Erica says to me, well, had I known this, I would have just bought a house back then. That's the last thing I want to hear from her. Like, I want her to know what she's getting with the decision she makes. And then it's not my fault. Because then if it's a year later and that's what she says to me, that's my fault. I didn't have that conversation and that's on me. So, like I said, I can do these for any scenario and it comes out where they're better off by not waiting. So let's talk about the person that's trapped in their home. This is one of my favorites. So you have one of your clients come back and say, hey, Will, like I would love to sell my house and buy another house, but like I'm in a loan that's 2.75. Like I just can't give that up. The common response to that is, yeah, okay, well, we're expecting rates to come down. So when they do, I'll circle back around and see how things are going then. Is what we don't know is the only good thing that they have going on right now might be that interest rate. So this is a real client. This is a real scenario. Owns a house that they bought for 450, but they want to move up to a larger home for 650. They've got a $200,000 mortgage at 2.75, which is great. They now have a HELOC of 50,000 at 10.25, a car loan, credit card debt at an average of 23% because credit cards are crazy expensive. Very little liquid cash, 5,000 in liquid cash, not making any money. Money's tight because of the disposable income. No life insurance. Has 2 kids. That's another conversation. Like if clients don't have life insurance to cover things, the last thing that we want them to have to do is sell their house because they didn't have proper life insurance coverage. No estate plan, will or trust, wants to retire by 60. No chance with the path that they're on. Some money in a 401k, et cetera, wants to help kids, all these things. So yes, the 2.75 is a great scenario, but unless we dive deeper into the conversation, we don't uncover all of these things that aren't going well. But if we can uncover all of these things, there's actually a path to get this person out of the home into a better situation, which this is what it looked like after they did that. Now they own a $650,000 home. They financed $550 because the rest of the cash went to pay off the car. It went to pay off the credit card, put money into savings, got life insurance. So now there's $45,000 in savings at a higher yield in a money market instead of just sitting in a savings account. Got a life insurance premium, now has an estate plan, a retirement plan. That's around having the conversation. Sure, the interest rate now is 6.75. So now that's the worst thing on this page, but everything else is great. So having that conversation, the problem is most people do this. When they're looking at a scenario of should I sell my house and buy another house, they're looking at their current mortgage payment, 1362 plus taxes and insurance, and they're comparing it to the proposed payment, 3113 plus 387. So that's a $1,600 payment to a $3,500 payment, and they're saying I can't afford that payment. Well, yeah, because you're comparing 1,600 to 3,400. But if we factor in other things such as now that installment loan went away, and this is a different client, by the way, clearly with the numbers, revolving debt of 1,005 for this particular situation, for them to sell their house, pay off their debt, move into another home, it was a $434 gap in payment, not an $1,800 gap in a payment. But that's through having the conversation and uncovering what's really happening and what's not happening in their life. And once we can get to that, we can help them make a different decision based on their actual situation and not just compare current first mortgage to new first mortgage, because that is not an apples to apples comparison. But that's what people do. I had a client in 2021 that wanted to take out some cash and refinance their house. And that's exactly what he did. He was like, well, I don't want to do that because my payment goes up X amount. And I was like, no, your payment's the exact same. And he's like, no, it's this. And is what he wasn't doing is he wasn't factoring his second mortgage payment with his first mortgage payment, which we were paying off. So he was actually getting a cheaper payment, but he was only comparing first to first, not factoring in the second. So it's our job to help uncover these types of things through conversations. And this is how we do it, with information and data to have those conversations. Last, this is just something for informational purposes if you wanted to share it with clients. It's a real estate report card. I put Will on this one. It's for Cache County, so it's co-branded for Cache County. It looks better when you actually send it to a client as a PDF. I just took a snippet so that I could put it into the presentation, but it will give forecasted appreciation for the county. So it'll show where they're expecting home prices to go. It also shows the historical information, median household income, homes that were built last year, renters, how many renters who could actually afford to purchase. And then it shows the affordability index for Cache counties at 74. The closer to 100, the better. Like the 100 is perfect affordable market. So obviously as rates come down, that should help with that situation. But this is just something that you could also share with like past clients that are maybe considering a move, want to know how things are performing in their area. And we can do these for every county. And like I said, I can co-brand it, which is why I threw Will on this one. Um, that's that. Here's my information. So if you guys have any questions, you're welcome to email me, or welcome to text me, reach out. Happy to have any conversations, share any additional information that's helpful for you. But at this point in time, we can take it to Q&A if there's anything in Q&A. Will,
Yeah, Bryce. Yeah, man, that was that was amazing,
let
dude.
me let me take a drink. Hang on, I got to take a breath.
Yeah, for sure, man. The biggest takeaway I think for me right there was at the end, dude, was that as a whole, we're just not having good conversations. We're not diving deep on any level. It's kind of what it feels like as a whole.
Yes.
Yeah. And so that's my biggest takeaway of this whole thing is, I am going to self-check and go back and replay some conversations and really work to improve the fact-finding mission. I think, like I said, was my biggest takeaway from there. One of the things that came up, Ken O'Boyle posted on here and said, excuse me, I got my other device up. Those people with 50% equity also probably are around 3% rate or lower.
Mhm.
And so that was a comment that he had on here.
High probability that they are. So then and not everybody's in those case studies that I showed with having a HELOC and having credit card debt and loans that they could pay off. Not everybody's in that situation, but those people that do have the equity position, the conversation from there can go to like they have a ton of equity, they're at a low rate. Just use like it's that whole term of like borrowed credibility. Borrow someone else's scenario and just say, hey, like I don't mean to pry, but like I've had some clients recently that, they've had to take on some credit card debt or things because of just how expensive things have been over the last couple of years. And so we've actually been able to look at scenarios where they sell their house, take some of the equity, give themselves a fresh start, get into the home that they like, they really, really need, that suits their family, and they're in a better situation. And in some cases, they're putting some of their proceeds into helping fund retirement if you're behind on that. Like, I don't know if that's the case for you. I don't want to make any assumptions, but that's what I've seen. So, is there any areas that you're maybe struggling that we could possibly have a conversation and help you out? You're coming from a place of like sincere care, like I want to help you, instead of like, hey, I really want you to sell your house so I can sell it and go buy another one. Like we have to ask if they're doing okay, if they're having those issues. And a big misconception for people is to that point, Ken, is they've got a ton of equity, they've got a great rate. Most people don't even know that they don't have to take their entire proceeds to the next house. A lot of people think whatever they make on the sale of their house, they have to take it to the next house and put it down. They can't pay off debt and do these other things. So that's where it's our responsibility to ask enough questions to find out whether or not that's a need or not. But there's definitely people that would fall into that category that don't have any debt, have 50% equity, sitting at 3% that would like to sell, but rates need to come down a little bit more before that's a reality. There's definitely people that fit that category, but that's great. Now we know where they stand and we know what the target is and when that time could possibly be. But our goal is to let's help the ones that really need help right now that are drowning.
Yeah, yeah, absolutely, dude. One of the things we have in here, Bryce, just a quick check, dude. We did have some live stream stuff happening, and I don't think everyone could get in. So this will get replayed out, and I'll make sure to address any questions, get it directly to you. So we
Okay.
were having an issue there, but just fantastic, man. I like always, dude. I always appreciate what you bring to the table and the knowledge you drop on us, dude. So I'll be spinning on this one for a while, and like I said, already changing my game of I'm changing my game of the information that I'm going to gather. So there's just no doubt about it. So always appreciate you, man.
Yeah, I mean, like I said, this is probably the one of the favorite things I get to do, which is the teaching part. It's something that I love to do, and I know how helpful it is with me in my conversations when this is the approach I take with clients versus trying to convince them to do something they want to do. And I'm the type of person that when I get to that point with a client that it's clear that I have to convince them to do something they don't want to do, I typically just remove myself from that situation
Right.
because that's
Yeah, we
not
were
the position I want to be in.
yeah, we were talking about that at length at lunch the other day. And yeah, that's a tricky one there for sure. So well, right on, man. I really appreciate it, dude. Anything that comes through, I'll definitely get you in contact and we'll follow up, but we'll keep moving forward, bud.
Awesome. This was a ton of fun. Let me know how I can help.
Yep. Thanks, Bryce. Appreciate you,
Okay.
man.
All right.
All right. Bye.